Hi, everyone. Thank you so much for joining us today. I'm Erin Creighton. I'm the Adult Services Department Head and Assistant Branch Manager for the Fredericksburg branch of the Central Rappahannock Regional Library. I'm very happy to be joined today for Wealth Wednesdays by Lamont Brown. Lamont is the owner and chief financial officer person. I just stumbled over that. I'm so sorry.
No worries.
Yes, of Allna Wealth Management, which is a Fredericksburg-based, company. So we are thrilled to be joined by Lamont, as always, for our Wealth Wednesdays. He's here to talk to us about Investing 101. This sounds really fascinating.
This is my area. I really like this area. Thank you, Aaron, for that intro. Picture this. You're on a brisk fall drive on rural roads of Vermont. After driving for a little while, you decide to stop at a quaint, small gas station in the middle of nowhere to get a snack or just grab something to drink. You go in, you pick up a few things, and you walk up to the counter. And behind the counter stands an elderly Ronald Reed. Funny thing about Ronald is that on the surface, Ronald looks like a hardworking guy just trying to make ends meet, taking care of the gas station. But below the surface is where the story truly lies with Ronald. Ronald has taken a simple strategy of buy, hold, reinvest to build wealth. And when Ronald actually dies, he is worth over $8 million. That's $1 million. And he puts the largest donation into the local library. With this simple strategy, it wasn't about looking for the high flyers, those big companies that are going to go through the roof. He was just focused on buying, holding, and reinvesting. Ronald is proof that simple strategies work when you actually work them. Many of you look at the stock market on on Yahoo or on the stock section of a newspaper, just like I did, with wonder and complete uncertainty about what it actually means to be in the stock market. But today, I'm gonna help you to understand all of those things they're talking about, to start to put together a strategy for yourself. My agenda is simple. We're gonna talk about what an investment is, how to actually invest, where to invest, some simple tactics that you can use to be just like Ronald, and then we're gonna cover the missteps that most people miss. All right. So I want you to do me this big favor. I want you to listen and listen to the whole presentation. And somewhere in the presentation, I'm going to mention the most important decision. And I want you to write that or put that in the chat window when you hear me say that. So now, without further delay, let's move on to what the market is. What is the market? When I say what is the market, what do you think of? What do you think of? Are you thinking of a bunch of people standing on a floor yelling at each other? Are you thinking of uh, your grocery store? What are you thinking of when we think of the market? Well, that's where we have to start. We have to be all on the same sheet of music and understanding what I mean when I say market. Next slide, please. When I say market, for the majority of the investment community, we're talking about the S&P 500, because this is the 500 top companies in the whole United States. It's not the 500 middle companies, not the 500 smallest companies. It's the 500 top companies by their total value. So when we talk about the market, we're really talking about the top 500. Now, there's a lot more stocks in the market on this day, but we're really focused on the performance of those top 500. And as we look at those top 500 companies, over the last 30 years, these top 500 companies, which change over time based on an algorithm, they've produced 10.49% on average per year. That's 10.49% per average. Now, that doesn't mean anything until you put it in comparison with something. You have to think about, okay, what is it comparison to? Well, let's talk about our savings account. Well, many of us go to our bank and we put our money in our savings accounts and we look up and the same amount we put in there is still there, but it's safe. But our savings accounts on average as of June 2025 are only producing 0.39%. So, with that said, we can just think about it from this perspective. The stock market, the stock market, if the past, if we look at the past, is looking at it 27 times the average of a savings account. As we know, past performance does not guarantee future, but we can look at it and say, if we look at the average over the last 30 years, the stock market has done 27 times more than the actual savings account. So that's why we need to understand investing, is because this is the way we're going to build wealth. Now, we're going to move forward today and we're going to talk about what an investment is next. When we think about investments, we think about a lot of things. We think about companies, we think about all these things. Simply and generically, an investment is a place where you put money or you buy something in hopes of future growth. You take some risk for future growth. Next, when I think of investments, I see a tree. I know I'm a little bit different that way, but I see a tree. And the reason why I see a tree, because the tree has three main parts, which really represent the parts of an investment portfolio. The first part is the roots, and the roots are the stability. That's where everything comes from. Everything starts with the roots. And then we have the trunk, which is the stability of the overall tree. And if the trunk is weak, the tree is weak, right? And then we think about the leaves, where all of the energy comes in and all of the movement happens in a tree. Now, on an investment scale, you want to think of the roots of your overall investment strategy as being the cash that you hold, because cash is going to drive your whole system. If you don't have a lot of cash, you're not going to have a lot of everything else. So you really want to start by focusing on cash, and cash is your stability. It's low risk, and it's normally, if it's in a bank, it's going to be FDIC insured, which means that a lot of things would have to happen before you lose that cash. So from there, we think about the stability, which is the trunk. The trunk is thick. It moves very little when the wind blows, but the trunk is more like your bonds in your portfolio. They provide that stability, but they also provide a great jumping off point for your stocks, which can go out and grow. And then you think about your stocks as being the leaves, which give you all of your growth and your future. So you want to look at it as a big old tree. So investments are really three basic things: your cash, your bonds, and your stocks. I know there's someone out there saying there's more than that. There's real estate, there's commodities, there's all these other things, but we're only focused on the basic parts of this: your cash, your bonds, and your stocks. Now that we know what an investment is, let's move on to where can we invest, or how can we invest. The first thing I always ask is, how do we go about doing this? Because stocks, bonds, and cash seem kind of like unclear terms. Let's talk about that next. Back to an analogy. When we think of stocks, bonds, and cash, I want you to think of direct ownership as going out and buying an individual stock or an individual bond. That's where you put your name on a contract and you actually purchase this. This is a great opportunity for you to know. You have to know exactly what you're buying, and it's a great opportunity for you to participate in the ups and downs on any individual stock or bond. This is an important point you want to understand. When you own one stock, how much risk are you taking? Well, if that one stock goes down, you have quite a bit of risk. If that one stock goes through the roof, you got quite a bit of gain, but you also are not diversified. So owning one of anything is not a diversifying method. You want to always be thinking about, at the end of the day, how much risk am I taking with this individual investment? So direct ownership is the easiest way and most direct way to buying a stock or bond. Now, looking at all of this, most people would say, okay, well, that's all I need to know. But most people want to make sure that their portfolio is protected. And so they start to think about, well, how can I protect my portfolio? And that's where we move to the next one. Next, and that is mutual funds. So, mutual funds take stocks and bonds to a whole new level. This is something that you have to understand. It's a wrapper. That's all it is. It's a wrapper. So, what they've essentially done is they said, we're going to pull together all these investments in stocks or bonds or stocks and bonds, and we're going to put them all in one place. And Lamont, you're going to be able to give us one thing. You're going to be able to give us $1 and be part of this whole pool. But what does that do for Lamont? Well, it does a lot for me. First off, one company or one pencil can't take out my whole portfolio. Now I'm diversified across many stocks or many bonds or many stocks and bonds. It gives me the ability to spread that word risk. I'm able to spread my risk across the whole spectrum. And if we talk about the S&P 500, which was the market, we can actually buy a mutual fund that is going to invest in all 500, and we can do it for a low cost versus us having to go out and buy each one of them individually. And if you thought about that, it'd be very, very expensive to do that. So at a lower cost, you're able to do that. Mutual funds were started over 100 years ago by a company that's still in existence today. It's a Massachusetts Investor Trust. It's part of MFS, if you're familiar with them. That's not a recommendation, just to tell you. So over 100 years ago, this wrapper was invented for this exact purpose. Some of the challenges with having mutual funds is they can be tax inefficient. So what that means is inside there's things happening. They're buying and selling. And whenever they buy and sell and they create gains or losses, they have to pass that on to you. And when they pass it on to you, it normally happens at the end of the year and it's a surprise. So that's where it can be really, really impactful and tax inefficient is owning a mutual fund. Now that we've covered mutual funds and direct, let's go to the new thing next. So, about 30 years, a little bit over 30 years ago, State Street said, we want to fix all those challenges with mutual funds, but we want to keep the good stuff. The good stuff is it's a pooled investment. A pooled investment. So, if I buy one share of an exchange traded fund, I get access to many stocks, bonds, or stocks and bonds. That's exactly what they set out to do. And that's what they did. And they created this exchange traded fund. It's a pooled investment, just like mutual funds, but it addresses a couple things. First, I didn't cover it earlier, but mutual funds trade at the end of the day. So you had to wait till the end of the day to receive your money or to execute a trade. With exchange traded funds, they trade all throughout the day. So you can buy it at 9 and sell it at 2 if you chose. Not recommending that, but that is an option with exchange traded funds. And they also address the tax inefficiency. That's not to say that exchange traded funds can't throw off capital gains, but it's a lot easier for them to manage those capital gains that they do throw off. So an exchange traded fund is an improved mutual fund that's only been in existence for the last 30 years. And it's the wrapper that has really changed the way we invest, because now we're investing in individual indexes versus individual mutual funds. That is where we are today. So now we've covered everything from what the market is, how what an investment is, how to invest. Now let's talk about the next part. Next, where to invest. I know you're sitting there thinking, okay, I got all these things. Where do I put it? And what do I need to know next? First things first, there is a traditional taxable investment account. This one is very simply a bucket. It is a jar, it's a bucket. We talked about trees, we've talked about pencils, and now we're talking about jars. This jar allows you to put whatever you want. And when I say whatever you want, you can put stocks in there, you can put bonds in there, you can put cash in there, you can put treasuries in there, you can put anything you want to. You're not limited on your income, you're not limited on how long you have to keep it in there. You're not limited on any of those things. The one thing you want to know about a taxable investment account is whenever you create a gain, a loss, receive a dividend, you're going to pay it in that year. That's why it's called taxable investment account. So anything that happens in that account over the course of the year, you're going to pay it quite like when you have your savings account and they pay you interest. When they do pay you interest, you pay it every year. Exact same thing. Inside of a taxable investment account, when you pay it, when you receive it, you're going to have to pay it at the end of the year. So those are the things you need to be looking at. But there's no limit on how much you can put in there or what you can put in there. That's the other part of this. Now, we covered the taxable. Next, let's go on to the retirement accounts. This is where most people completely understand the situation. They understand the difference between traditional and Roth. Well, if you don't, I'm going to help you. The difference is really they the traditional IRA is pre-tax, which means when you put money in, you could potentially reduce your income for that year, potentially, because it's based on your income level and all of those things, right? So you really want to understand why you're putting money in there. And for that, when you put that money inside that traditional IRA, you're able to put it in there and save it. And when you do those exact same things you did inside the taxable account, like you buy a stock, you sell a stock for a gain, you receive a dividend, well, you don't pay any taxes on it while that money is inside that account. While that money is inside that account. I said it twice because that is something you need to know. When you're thinking about it, anything that happens inside that account just does not impact your taxes until you take that distribution. So when you reach the ripe age of 59 and a half and you decide to take money out in a qualified distribution, when you take that money out, that's when you pay the tax. The tax is treated differently than it would be in a taxable account. And I'm not going to get into that, but just understand it's a different type of tax, generally speaking. And when it comes out, you're going to pay that tax just like you would with your taxable account, but you only pay at distribution, not while it's growing and while it's inside that account. Now, on the flip side, you have this thing called a Roth. This was an improvement on the original traditional IRA. Quite like exchange traded funds improved your mutual funds, this is an improvement on the traditional IRA because now when you put money in, you're not getting a tax benefit. It's not potentially deductible. So I put money into a Roth IRA, I'm not getting a deduction. I know this, it's going to grow the exact same way as traditional IRA. So anything that happens inside that account, I don't pay taxes on. So if I buy, sell, do whatever inside the account, as long as it's inside there, I don't have to worry about it. I'm not having to report it on that year. And here's the kicker. If I wait until I'm 59 and a half, I've held it for at least 5 years, and then I start making those qualified distributions from a Roth IRA, what's happened? They come out completely tax free. This is magic, right? Not, well, it's not magic. It's just rules. But you want to understand that whenever you put money into a traditional IRA, you grow it, it's going to come out. You're going to pay taxes on it because you took a deduction in the beginning. When you do the same to a Roth IRA, you pay taxes before it went in and you grow it. And then when it comes out, it's completely tax free. So now there's the improvement. Not everyone is going to have one or the other. Probably most people are going to have a mix of those, and it's probably best to have a mix of those. Some that's pre-tax, some that's raw. But you really want to understand there's going to be taxes at some point. So we've talked about the main things about where. We talked about the taxable. We talked about we talked about the retirement accounts, and now let's go on to the tactics. This is where the rubber meets the road. All that stuff before was really there to set you up for this point. What do you do with that information? Next slide. The first and most important decision that you will make is your investment allocation. That's how much of this or that will you add into your portfolio. And when I say this or that, I'm talking stocks, bonds, cash. The more stocks you get, the more risk you will have. The more risk you have, the more potential gain you will also have. The more bonds, stability, remember that tree, the less risk you will have. But the so the more bonds you have, the less risk you will have, and also the less growth you will have. So this is the most important decision you will make. How much stocks, bonds, and cash are you going to add to your portfolio? This is not throwing darts. This should be based on your long-term goal for this money. So if I'm investing for my kids to go to college in 18 years, that's one portfolio. If I'm investing to retire at 65, that could be a completely different portfolio. And this mix has to change based on that. And then in the end, you want to be thinking about how much risk do I need to take in order to hit my goals, and then determine how much of those you're going to have. So the most important decision you're going to make is your investment allocation. Notice I didn't say whether you invested in this stock within this mutual fund or any of those things. The most important decision you're going to make is going to be how much in stocks, how much in bonds, how much in cash you're going to keep. Next. Now, once we've put that all together, this is just like your yard. Every year, I mean, I kid you not, every year I start out the spring, I am Mr. Green Thumb, right? By the end of the summer, I am Mr. Brown Thumb, and my yard looks like trash. Why? Because I don't do the maintenance. I mow the yard, and that's about the extent of it. Well, a portfolio is much like your yard. If you don't take care of it, it's gonna get out of whack. You're gonna get more weeds than you want. Your grass is gonna grow. It's not gonna grow. All those things. Well, think of rebalancing as that maintenance to that portfolio. And over an 8-year period, I'm giving you an illustration here where you started out at 60% stocks, 40% bonds. That was your allocation, and that's what you needed to grow your portfolio. Well, over time, things have happened. Your stocks have gone up, your bonds have gone down, which is pretty normal because stocks are going to grow at a much faster rate than bonds. By the end of the 8th year, you're in a completely different risk category. So by the 8th year, you're in a 74% stocks and 26% bonds, which is completely more risk than you probably need to be taking at that point. So rebalancing is really resetting. So you're allowing your stocks to run and you're allowing your bonds to change, and then you go, okay, we run. And then if the stocks have gone up and the bonds have gone down, you're selling off some of the stocks to buy more bonds. So you're selling the stocks that have grown at the high, and you're buying something that has not grown at the low. And you're able to shift your portfolio back to that risk level that you need to achieve your goals. This is the maintenance phase. So make sure you're taking care of your yard by rebalancing, because once you've done all the hard work and the most important decision is the allocation, and now you're taking and executing that with the rebalance here. Next, finally, we want to talk about dollar cost averaging. It's not magic, it's just numbers. Essentially, With dollar cost averaging, you're taking the same amount of money and putting it in the market regardless. Rain, sleet, snow, whatever. Anything, nothing's gonna change you putting your 100, your 1,000, your $10,000 in the market. And because of that, every time you go to the market, depending on the value of the stock or mutual fund or exchange traded fund you're buying, the price of it is going to determine how many shares you get. So if I invested $100 today and the share price was $1, I'd have 100 shares. Well, if I invest next month $100 and the share price is $2, now I'm only going to get 50. So essentially, I'm buying more when the price is low. I'm going to a discount store to buy eggs. And when the price goes up, I'm buying less. So when I go to the convenience store, I don't buy as many eggs as I would at a discount store because those convenience store eggs are expensive. But anyway, we're going to go beyond that. So over time, essentially, your average tends to go towards the middle, and you're kind of in a way protecting yourself because you're taking the emotion completely out of your investments, just like Ronald Reed. Ronald Reed didn't consider markets up, markets down. This company is doing better than that company. He just went and he bought on such a systematic way that it did not impact his overall goals, and he took the emotion completely out of it. And that's what dollar cost averaging is. You just take the emotion out of it and you just allow the numbers to work for you. So we covered a lot so far. We covered all of the what is an investment. We covered how do you invest. We covered where do you invest. We covered the tactics, which I've given you 3 here. And now let's go to the missteps. Number 1 is being invested in the wrong thing for your situation. This is that allocation question. The number 1 mistake people make is they select the wrong investments for your situation. So you're getting ready to retire in 10 years and you've invested very conservatively, or you're getting ready to retire next week and you're invested very aggressively. Those are wrong investments for your situation. Your child's going to college in 30 years and you've invested very conservatively. Those could be the wrong investment for your specific situation. So the number 1 misstep most people make is investing wrong for their situation. Next, not considering taxes. I have all this money. It's sitting in my traditional IRA and I want to take it all out tomorrow. I'm 59 and a half. Well, that's going to be a tax impact. And you not considering the impact and understanding that you're going to pay tax on every dollar that comes out is an important thing to know. And it's an important misstep. I hear it all the time. People saying, I want to take out all my money to go do X. Well, the challenge is you have to consider the taxes. Not all things are going to be taxable, but you want to know what they are and you want to consider those taxes when you actually are making those decisions. Next, forgetting liquidity. All right, so you put all your money into this basket and you can't get it out. Well, do you still have that money? You have to ask yourself, how do I pull my money out if I have an emergency, a medical emergency, or anything goes on in my life? I need to adjust. A lot of people will forget, how will I access this money? There's a lot of products out there and solutions where you put your money in and you can only take it out in dribbles or drabs, but maybe you need more than that. So you want to be considering, how much will I need if I need, and how can I take it out? Those are important questions. So first, investments in the wrong for your situation. Second, not considering taxes. Third, forgetting liquidity. And the final thing is not starting. I started investing over 30 years ago, and if a guy from Midland, Texas can pick up a stock section of a paper and figure it out over these years, you can do it too, just like Ronald Reed. Next slide. So throughout this presentation, I clued you into what the most important decision should be for you. I want to see how many people are listening. Put it in the chat. What's the most important decision you should be making?
While we wait to see what the responses in the chat are, Lamont, can I give you my guess?
Yeah, go ahead.
Is it the diversification? Like, don't put all your eggs in one basket.
Yep, the allocation part of this. You're a winner. Winner, winner, winner.
Yay!
Yeah, so that is the most important decision you'll make. How many stocks and bonds and things that I will have will really control your outcomes and the risk in your portfolio.
And honestly, like the common pitfalls, the one about not starting, I think it's one of those things that if people keep thinking, well, I'll deal with this later, but you and I have talked a lot about the power of compound interest.
Exactly.
And the longer you give that power, the greater benefit you get out of it.
Yeah, and I often think of this quote, time can be an asset or a liability. And the longer you wait, the more time becomes a liability or something that you're going to have to pay for later. So you just want to really, really put time on your side and make it work for you.
Yeah. And if you have any other questions, please contact Lamont. Like I said earlier, he is the owner and wealth manager for, I didn't stumble over it this time, for
You got
Alma Wealth Management and here in Fredericksburg. And I'm putting your website up on the screen as well. Lamont, thank you so much. This was fantastic as always. I hope you gave our community here the empowered feeling to go out there and look into some of this themselves or to contact you and ask for more help.
I'm always open. My phone always rings and I always return emails. So just reach out. It doesn't cost anything to call me and get a quick answer. I'm always there for that. That's what I'm here for. So thank you.
Thank you so much. We really appreciate it. And have a great rest of your day, everyone. Thank you so much for watching.